The time has come for the Cobra to rise up and reveal himself.
Our third and final tool, but our most used tool, because it is the most immediate tool of monetary policy, are open market operations. In fact, this tool is so important, there is the Federal Open Market Committee, which is specifically in charge of this operation. And the goal of this is immediate cash liquidity into the banking system or emergency removal of money out of the banking system. And what open market operations is, so if you see the FOMC, the Federal Open Market Committee, it is the committee of the Federal Reserve in charge of this operation. And what this operation is the buying and selling of government bonds, known as treasury bills or T-bills, to and from its member banks. Now, a bond, as a personal finance tool, is a certificate of a loan. And that means if you, for X years, in X years, you get the value of the bond plus a yearly compounded interest. So in terms of personal finance, you pay for a bond, you get a certificate, and on that certificate it says the value of the bond. And in X years, called the maturity date, you get the value of that bond back plus a yearly compounded interest. So you receive your principal plus a yearly compounded interest, which means interest that grows on that interest rate. So it's a great way, not for necessarily getting rich, but for preserving wealth. You can buy government bonds, you can buy treasury bills, you can buy corporate bonds, and when we talk about bonds in another lesson, we'll talk about the coupon rate as well. But the Federal Reserve buys and sells bonds from its member banks to either inject money into the banking system or to withdraw money from the banking system. And that, because that bond is a certificate, it's the amount that the bank will either have or will give to the Federal Reserve. So buying bonds would be an expansionary policy, and we're going to do the whole chart in our next slide about this, because it is the most used, but is also the most complex. So the Federal Reserve gives money to banks in exchange for the bond. This is an immediate injection of cash. The Federal Reserve, the bank gives the Federal Reserve the certificate, the bond, and the Federal Reserve gives the bank money, the value of that bond. And so now the Federal Reserve is going to hold the treasury bill, and now the bank has an immediate injection of cash. Selling bonds is the contractionary version of this policy, and it's why a lot of banks choose not to be a part of the Federal Reserve, that even though they don't get that member discount, they're also not subject to the Federal Reserve's reserve requirement ratio and the selling of bonds. When the Federal Reserve sells bonds to the banks, it makes the banks give money to the Federal Reserve, and the Federal Reserve gives the bank the bond. And this is an immediate removal of cash, of excess reserves from the bank, because now the Federal Reserve is holding the money and the bank has a certificate. It has the treasury bill. Let's take a look now at this process in full. So let's break down our two different types of open market operations a little further. First, for expansionary monetary policy, the open market operation of buying bonds. And the alliteration to help you remember it is buying bonds equals bigger bucks. The Federal Reserve will buy bonds from the member banks. That means the member bank gives the bond to the Federal Reserve or sells the bond to the Federal Reserve. The Federal Reserve is buying the bond from the member bank. And remember, that bond is a certificate. So the Federal Reserve will give money to the bank in exchange for that bond. Now, that bank's excess reserves has increased. Very important to remember, the required reserve ratio only applies to deposits and not to open market operations. So when the Federal Reserve gives this money to the member bank in exchange for the bond, this money goes directly to excess reserves because the required reserve ratio only applies to deposits. Because remember, the goal of the open market operations is immediate liquidity. So the Federal Reserve only has the required reserve ratio for deposits from people to the bank, not for open market operations. So the bank receives the full amount of this money straight to excess reserves. Now, the money supply, the amount of M1, is immediately increased. And now the bank has all of this extra money. How does the bank tell people, hey, we have all this extra money, come borrow from us? The bank will lower the nominal interest rate, the headline rate, which will decrease the federal funds rate, the rate at which banks lend to each other, and also will decrease the real interest rates. All of this will increase borrowing in the economy, increase investment spending in the economy, and increase aggregate demand. And this is the most used operation, especially to fight recession, because it is the most immediate. The bank gets that immediate injection of cash to decrease the money supply, and then it can begin lending money when people and businesses come to the bank to borrow. So this is the one that's most commonly used to fight economic recessions. Now, let's take a look to fight inflation. The contractionary monetary policy, and the alliteration to remember that is selling bonds equals smaller bucks. That there is now less money in the banking system. The Federal Reserve, to fight inflation, to pull money out of the economy, and to reduce the amount of money flowing through the banking system, and to reduce borrowing and investment spending and aggregate demand, will sell bonds to the banks. That means that the Federal Reserve gives the member banks the bonds in exchange for the member banks paying the Federal Reserve for those bonds. And now, how do the member banks pay the Federal Reserve for the bond? With its own excess reserves, with the member bank's excess reserves. So now the member bank has a bond, but it also has less excess reserves. This decreases the money supply as it took all of that M1 out of circulation. It's now sitting in the Federal Reserve while the bank has a bond to show for it. With a decrease in money supply, with less excess reserves from the bank now has less money to lend. How does the bank tell everyone, hey, we have less money to lend, don't come to us? And for itself also now make more with less, it has to increase the headline rate. It will increase the nominal interest rates. This will then increase the federal funds rate, the rate at which banks lend to each other, and it will increase the real interest rate. All of these increased rates will create a decrease in borrowing, a decrease in investment spending, and a decrease in aggregate demand, pulling money and spending out of the economy and fighting inflation. These are the three tools of monetary policy, how the central bank uses the three tools to either fight recession or fight inflation, and in the process, creating stability in the banking system. Thank you for watching. Remember, whether it is your money, your mind, or your body, invest hard, invest often, and no feelings. And money never sleeps.